Hi, everyone. Welcome to Market Insight for Monday, December 30th. Normally you see our Market Insight videos on Saturdays, but with the new year approaching, we decided to permanently move the video to Mondays so that we can focus on our conversations on the week ahead, and you can then better navigate the markets and make better decisions on our insights. So joining me now is my friend and editor, Ian King, editor, of course, of Automatic Fortunes. Ian, welcome.
Hey, Jeff. Happy holidays. Nice to see you.
Yeah, same here. Happy holidays to you as well, and a happy New Year as we approach that New Year. And I guess that's the thing here. We have Ian, an extraordinary setup going into 2020. In my view, we have an election year. The U.S.-China trade impasse appears to be getting resolved. We're looking back on three rate cuts by the Federal Reserve over the last 12 months. And we have the S&P 500 and the NASDAQ both climbing to new all-time highs, day after day through the holiday period. Given all that, I mean, what do you expect, as we hit the new year here? And what are the markers that, in your view, we should all be paying attention to? You give your opinion, I'll give mine after that.
It's a great question. Given all those things that you ticked off just there, it sounds like we're going to have a really busy year ahead for the stock market. And I want to just remind our viewers that 2019 came in like a lion and it's going out like a lamb. I mean, let's take a look at the fear and greed index right now. This is something you and I have discussed. I just want to pull this up. A year ago, we were sitting at extreme fear. The reading was at 8. And just recently, yesterday, we hit 93, which is an extreme greed. Now, this index, to explain to our viewers, what it does, it takes 7 other indicators and measures them and then scores them, so you kind of get a barometer of what people's sentiment are. And these indicators can include anything from volatility or the put-call ratio or the spread between junk bonds and high-grade bonds. So they're an indication of how much investors in different asset classes feel like the market is risky right now. And right now, everyone is greedy. Things are going really well as we exit the 2010s into the new decade. What do you think about that?
I obviously, you can sense the extreme bullishness out there. And I think the big question for every investor, and certainly for you and I, we've been contemplating the same thing as well. Given the extreme bullishness, it's natural either one to join the party or just cheer it on even further, as many people do, or to pull back expecting some deeper correction. And I will tell you, I've been warning people, I'm kind of on record about this, that to expect some sort of correction. And I say that not necessarily with some great amount of conviction, but more just in the sense of understanding where the risks are. And the further we go without a correction, I believe corrections are healthy because they deflate some of that bullish sentiment. If we can get that early in the year, I think that really will portend a really strong 2020 as well. But I also believe that if we keep going and we don't get any sort of significant pullback, obviously it could just keep going from here for weeks or months. So I'm not predicting a bubble. I'm not predicting some sort of large collapse or anything. I think people should continue to invest, but you do need to be aware of the risks as the market moves higher here, especially if it does so without some sort of correction for the reasons you point out there with that index.
Yeah, I think that's a good way to look at it. I'd also mention the fact that just because people are extremely greedy doesn't mean the market has to top, right? There's the famous saying that markets stay irrational longer than you can stay solvent, which is what John Maynard Keynes said. And in fact, if you look at that fear and greed index, we actually were in extreme fear for a few months before the bottom happened. I follow this index, and it hit extreme fear in October. And the 2018 sell-off did not finish until just before Christmas. And then we've had this outstanding rally all of 2019. So we could stay in this, bullish pattern for longer than most people think. And it's also a contrary indicator that we're talking about this right now. I see a lot of people talking about this index right now, and I kind of want to fade them because they're saying, oh, the market has to peak soon because everyone's so bullish. But it just things stay irrational longer than you can stay solvent. That's why.
That's exactly right. And I've told,
yeah.
I'm sorry, Ian, I didn't mean to step on you there.
Go ahead. I just wanted to segue into what the next thing we want to talk about, which is the big economic number coming out next week. We've got the unemployment report coming on Friday. Obviously, last month in December, that was a big number for the markets. The government reported 230,000 new jobs in November for the December report. And so we could see some more fireworks again late next week. So at the end of the week, when the government reports the unemployment number at 8:30 Friday morning. What do you think about that? I mean, what should we be focused on really when that number comes out?
Yeah, my view of economic reports is to certainly take them in as a broad outline, a broad indicator, like, seeing a big billboard as you drive past it on the interstate telling you where the next McDonald's is. It's somewhere ahead and you have a general idea, but you may or may not stop there. So with that in mind, what I'm thinking about for that employment report is it will likely, yes, confirm what we already know. The economy continues to improve, and perhaps, maybe still a bit on the slow side, but that would just mean that the Fed stays on the sidelines even longer, which, it's already indicated for 2020 will most likely be the case. And the main thing is just going to be, in some ways, ignoring some of the fluctuations that may come with a headline about the employment number, because it could just as easily be great and the Wall Street types end up it, right? And so Friday ends on a big down day, but then, the following week, the market picks up where it left off and continues to just slowly march higher. So that's where I tell people, yes, you want to pay attention to these economic milestones, these economic data reports, but at the same time, you really need to watch your stocks and think about those and think about buying the pullbacks and buying the corrections if it comes, rather than obsessing about any one particular number.
Yeah, absolutely. And I think the other thing is the fact that this rally in 2019 was really driven by the Fed. I mean, the Fed went dovish early in 2019. They cut rates 3 times this year, and now we're seeing them flatten out. So we've kind of plateaued on rates. And between you and I mean, Jerome Powell is not going to raise rates in an election year. It's just not going to happen. I mean, he is going to lose his job before he raises rates in an election year. And Trump will put somebody in there that won't raise rates. So I think that if the market starts anticipating there's going to be rate hikes, I think it's the wrong way to think about it. We might have a little sell-off if the market thinks we're going to raise rates, but I think that your call for a continuation of the rally after a little pullback seems more likely than anything else. I think it's the likely outcome of 2020.
Yeah, one thing I tell my subscribers quite often is, and I know you think the same way, that both for stocks and for markets, new highs tend to beget more new highs.
Right.
It encourages momentum. And obviously, you don't want to be that person who makes a brand new stock purchase with a huge amount of money right at the top, although somebody's going to do that when the top comes. But we don't know that. And nobody will know that because until we actually see it, which people have been calling for a top for 10 years now. And we still haven't seen one yet. And that's something, if you feel like you're getting too bearish, you have to keep that in mind. That's why, as we talk about with corrections, yeah, a correction would be good. And as for the rest, it will basically take care of itself.
I agree with you. I would rather be bullish at the top than bearish all the way up. And, a stat that I shared with you earlier that I want to tell our readers about is that the NASDAQ has reached a new high for the last 11 days. And this is not something that's happened since 1998. Now, you might think, because the NASDAQ's reaching a new high every day, we're about to peak. But 99 and 2000, before the market crashed, were the 2 best years to invest in the late 90s. And it hit these new highs, and then it went on to make these incredible gains when people thought they were missing out on .com. So we might be seeing, another setup like that where the stocks just melt up because there's no other place to invest. Rates are low, the economy is trudging along, there's no recession in sight. Valuations are stretched more than they have ever been in the past, but that doesn't mean that they can't be stretched even more 6 months or a year from now. So,
And Ian, one thing I pointed this out to people before, there's also the idea of rotation. Institutions that really push stocks up and down, obviously they've been riding the likes of Amazon and Apple and the other, Facebook, Netflix, et cetera, have been the big drivers for the S&P 500 and for their own institutional portfolios. But there's nothing to say that we will see a rotation as money sort of drains out of those stocks, which are somewhat overvalued, I think, by most measures, into other stocks that haven't participated as much in this rally to date. So, just because one set of stocks in the S&P 500 or the NASDAQ looks wildly overvalued doesn't mean the index itself will, fall. If there's a belief that the economy will continue to support a reasonable valuation, you could just as easily see this rotation into value stocks, which has been going on for the last 3-4 months anyway. And so if that happens, the bull market can continue. And these other big stocks that have been leading it just take a breather for a while other stocks take the lead.
And that's a great argument for diversification. You don't want to be overly loaded in tech stocks. You don't want to be overloaded in energy stocks, because it happens more often than not that the market keeps going higher, even though the stock that you're in isn't going with the market, because you're not diversified. You don't own something in every one of those different sectors that you've talked about. So what else do you think could happen in 2020? I mean, let's look at, potentially some political headwinds. Any of the candidates on the Democratic side worry you a bit? I mean, I know there's talk out there that Bernie Sanders might win the Democratic ticket in 2020. Does that concern you from an investor perspective? I've looked at some of his economic platform, and it sounds like it could just be a disaster for the stock market.
Yeah, my sense of things are, I just try to think of it through the market's viewpoint, which is if there is a Democratic platform which investors don't believe is conducive to higher stock prices, and it looks like that particular candidate, whoever it turns out to be, is going to get the nomination, then we will see the market start to sell off, and whether it sells off a little or sells off a lot, who knows? But there's also the other question is who can really compete against Trump, because a surging stock market like we've seen usually helps the incumbent presidential candidate. So, again, it's like one of those things where we have to just sort of take a step back and not get too involved in it. I don't think the political ramifications will really come to the fore for investors and for Wall Street until we actually get to the Democratic convention and see who the real nominee is. And of course, you have Bloomberg out there who may get traction or may not. That's yet another wild card in all this. So it gives us all plenty to talk about, but the market could just keep moving higher as it sort of discounts a lot of these possibilities.
Yeah, I mean, there were so many concerns, whether it be trade or impeachment, in the last 3-4 months, and all we've seen is just higher prices. I think a lot of that negative news was already discounted in the market months before these actual events even happened. So, to your point, I'm watching the polls right now. It seems like Biden has the lead, so we don't have to worry about a more socialist turn in the United States at this point just yet. And I still think that's good for the market in 2020 and beyond.
And also remember, Ian, that for pretty much every candidate, save for a few, typically, they will speak to their base when they're campaigning for the nomination. After they get the nomination, they tend to move towards the center, obviously, to get more of as many votes as they can. So even there, it's sort of a moving target. So we just have to be prepared. And I'd say, if we're just going to wrap this up a little bit, it sounds like you and I are in full agreement here. You need to maintain a bullish stance, understand what the risks are, and just let the year play out as it may. And if we do get a correction of some kind, especially one that comes early, that could actually be a very good thing overall for the market.
Yeah, one other thing, it's just specifically short term, I would watch out for early in January is tax selling. So people who had big gains in 2019 that didn't want to sell and have to pay capital gains from the stock they bought in late 2018 are going to wait till early 2020 to sell those. And I think that might be a narrative that actually drives the market lower early in January, but an opportunity to buy stocks cheaper after that pullback.
Absolutely. Well, Ian, boy, it's been great having this conversation. I feel like we really fleshed out a lot, and I really appreciate you taking time out from your schedule to chat.
Always great to talk to you, Jeff. Happy New Year, and I'll speak to you soon. Thank you.
And for all of us, to all of you watching and listening at home, a Happy New Year. Enjoy the holiday, and we'll see you in 2020.